Most investors spend their entire lives chasing returns the wrong way. They study stock charts, memorize economic indicators, and search endlessly for the next big opportunity. They believe wealth comes from picking the right stock, timing the market perfectly, or discovering the next hot asset class before everyone else does. But what if I told you that the wealthiest investors in the world are playing a completely different game? A game that 99% of investors don't even know exists? This hidden world is called GP stakes investing, and once you understand it, you will never look at investing the same way again. Most people invest as limited partners. They put their money into mutual funds, index funds, private equity funds, or real estate deals and hope the manager performs well. If the investment succeeds, they earn their share. If it fails, they lose their capital. They are passengers in someone else's vehicle. But the real power lies with the general partners. General partners don't just invest money, they control the investment vehicles themselves. They manage capital, they make decisions, and most importantly, they earn fees. This is where the real wealth is built. Michael Rees explains that GP stakes investing means buying ownership in the asset managers themselves, not just the funds they run. Instead of investing in a private equity fund, you invest in the company that manages dozens of funds. Instead of earning one investment return, you participate in a stream of management fees, performance fees, and long-term enterprise growth. It's a completely different level of investing, and almost nobody talks about it. Traditional investors think in terms of annual returns. They ask questions like, what is the expected IRR? What multiple will this investment produce? What is the downside risk? But elite investors ask a different question. Who controls the assets? Because control creates leverage, and leverage creates exponential wealth. Imagine two investors. The first invests $1 million into a private equity fund. If the fund performs well, maybe they double their money over 10 years. Now imagine the second investor uses $1 million to buy a minority stake in a private equity firm managing $10 billion. That firm charges 2% management fees. That equals $200 million per year in revenue. Suddenly, the scale changes. The second investor isn't just benefiting from one investment. They are benefiting from the entire ecosystem of investments. This is the GP stakes advantage. When you invest in a fund, your interests may not perfectly align with the manager. They earn management fees regardless of performance. But when you own part of the management company, your interests align with the long-term growth of the business. You benefit from fee growth, business expansion, new fund launches, strategic acquisitions, brand value, talent development. You become a partner in the entire enterprise. This changes how decisions are made. Michael Rees explains that the best GP stakes investments are not transactional relationships. They are partnerships. The investor provides capital and strategic support. The asset manager provides expertise and growth. Together, they build something larger than either could alone. And this partnership model has created enormous success stories. Many of the world's most successful alternative asset managers have taken GP stakes capital to accelerate growth, expand globally, and build institutional infrastructure. Behind many of these firms are GP stakes investors who quietly participate in their long-term success. But GP stakes investing also requires a different mindset. Traditional investors think about entry price and exit price. GP stakes investors think about durability. They ask, will this firm still be managing capital in 20 years? Does it have succession planning? Is the culture strong? Are incentives aligned? Is leadership visionary? Because GP stakes investments are long-term commitments. Some investors hold GP stakes for decades. This patience creates extraordinary compounding. Instead of chasing short-term gains, GP stakes investors allow businesses to mature and scale. And this long-term approach often produces returns that outperform traditional investments. But there is something even more important that Michael Rees highlights. GP stakes investing is about people. Asset management is not a commodity business. It is driven by talent, judgment, and relationships. A great investment firm is built around exceptional individuals. GP stakes investors spend enormous time evaluating leadership teams. They study decision-making patterns. They analyze track records. They assess integrity. Because the success of the business ultimately depends on the people running it. This human element makes GP stakes investing both challenging and powerful. You are not just analyzing financial statements. Most investors think returns come from appreciation, buying low and selling high. That's the traditional model. But GP stakes investing introduces multiple layers of income that operate simultaneously, creating what elite investors call stacked returns. Michael Rees explains that GP stakes investors earn from several sources at once. And this combination is what makes the model so powerful. The first layer is management fee participation. Every investment fund charges management fees. Typical private equity or alternative investment firm charges around 1% to 2% annually on assets under management. Most individual investors think of these fees as a cost. Imagine an asset manager with $5 billion under management charging a 1.5% management fee. That produces $75 million in annual revenue. Now imagine owning 10% of that firm. That stake gives you exposure to $7.5 million per year in revenue participation, before performance is even considered. And this income doesn't depend on market timing. It doesn't depend on perfect decisions. It depends on assets staying under management. This is why sophisticated investors love GP stakes, because predictability reduces risk. Markets rise and fall, but assets often remain invested for years. Institutional investors commit capital for long periods, which stabilizes fee income. Pension funds, insurance companies, and sovereign wealth funds typically allocate capital with long-term horizons. This creates recurring revenue that continues through economic cycles. But management fees are only the beginning. The second layer of GP stakes returns is performance fees, often called carried interest. Carried interest represents a share of the profits generated by investment funds. Typically, asset managers earn 20% of profits above a certain return threshold. This is where extraordinary wealth can be created. This diversification multiplies opportunity. One fund may underperform, but another may generate exceptional returns. The GP stakes investor benefits from the entire portfolio of activity. Michael Rees emphasizes that this structure creates a powerful asymmetry. Downside risk is moderated by recurring fees. Upside potential is driven by carried interest. Few investment strategies combine these characteristics so effectively. But there is a third layer most investors never consider. Imagine an asset manager with $5 billion under management charging a 1.5% management fee. That produces $75 million in annual revenue. Now imagine owning 10% of that firm. That stake gives you exposure to $7.5 million per year in revenue participation, before performance is even considered. And this income doesn't depend on market timing. It doesn't depend on perfect decisions. It depends on assets staying under management. This is why sophisticated investors love GP stakes, because predictability reduces risk. Markets rise and fall, but assets often remain invested for years. Institutional investors commit capital for long periods, which stabilizes fee income. Pension funds, insurance companies, and sovereign wealth funds typically allocate capital with long-term horizons. This creates recurring revenue that continues through economic cycles. But management fees are only the beginning. The second layer of GP stakes returns is performance fees, often called carried interest. Carried interest represents a share of the profits generated by investment funds. Typically, asset managers earn 20% of profits above a certain return threshold. This is where extraordinary wealth can be created. When a fund generates strong returns, carried interest can dwarf management fees. Some asset managers earn hundreds of millions or even billions from carried interest alone. GP stakes investors often receive a portion of that carried interest. This creates upside exposure that traditional investors rarely experience. Instead of earning only their share of profits from one investment, GP stakes investors participate in profits across multiple funds and strategies. This diversification multiplies opportunity. One fund may underperform, but another may generate exceptional returns. The GP stakes investor benefits from the entire portfolio of activity. Michael Rees emphasizes that this structure creates a powerful asymmetry. Downside risk is moderated by recurring fees. Upside potential is driven by carried interest. Few investment strategies combine these characteristics so effectively. But there is a third layer most investors never consider: enterprise value growth. Asset management firms are businesses. And like any successful business, they can grow in value over time. When assets under management increase, revenue increases. When revenue increases, profitability increases. When profitability increases, valuation increases. A firm managing $2 billion today might manage $20 billion in a decade. That growth can transform a GP stake into a highly valuable asset. Some GP stakes investors achieve substantial returns simply by holding ownership stakes while firms expand globally and launch new strategies. Traditional investors chase opportunities. GP stakes investors build ownership positions. Michael Rees often explains that GP stakes investing is closer to private business ownership than traditional asset allocation. You are investing in people, systems, brands, and long-term franchises. But GP stakes investing also involves sophisticated deal structures. These deals are carefully designed to align incentives between investors and asset managers. A typical GP stakes deal involves a minority ownership position, often between 10% and 30%. Growth sounds positive, but excessive growth can harm performance. Some strategies work well at smaller scale, but struggle with large capital bases. If performance declines as assets grow, long-term value may suffer. GP stakes investors must understand capacity constraints. They must evaluate whether firms can scale effectively without compromising results. These risks make GP stakes investing complex. This is not a strategy for casual investors. It requires deep research, extensive due diligence, and long-term thinking. But for those who understand it, GP stakes investing offers access to one of the most powerful wealth-building engines in the financial world. Because instead of participating in markets, GP stakes investors participate in the infrastructure of markets. They own the businesses that make investing possible, and ownership is where true wealth is created. By now you understand something that most investors never discover in their entire lifetime: the real power in investing does not always come from choosing assets. It comes from owning the firms that control those assets. This is why GP stakes investing has become one of the most powerful strategies used by billionaires, institutions, and elite investors around the world. But the question is, why do the biggest investors dominate GP stakes? The answer is simple: they understand scale. Large institutions such as pension funds and family offices think in decades, not quarters. They are not chasing fast returns. GP stakes fit perfectly into this mindset because they produce long-term income and enterprise growth at the same time. Michael Rees often explains that GP stakes investing rewards patience more than speed. The best GP stakes investments often look ordinary in the beginning. The asset manager may be small, assets under management may be modest, revenue may be limited, but what matters is trajectory. Great investment firms often start with a small group of talented professionals and a clear strategy. Over time, they build trust. Clients increase allocations. Performance records grow longer. Infrastructure becomes stronger. And slowly, assets begin to multiply. A firm managing $1 billion can grow to $5 billion. A firm managing $5 billion can grow to $20 billion. And a firm managing $20 billion can become a global investment platform. GP stakes investors position themselves early in this growth curve. This is where the biggest gains are created. Michael Rees emphasizes that identifying future leaders in asset management is one of the most valuable skills a GP stakes investor can develop. The best investors are not simply looking for firms that are already successful. They are looking for firms that will become dominant in the future, but the quality of decision makers remains the most important factor. And this insight separates elite investors from average investors. There is also a powerful psychological shift that GP stakes investing teaches. Most investors think like consumers. They buy financial products. They compare performance numbers. They switch investments frequently. But GP stakes investors think like owners. They build relationships. They support growth. They think in decades. And ownership thinking transforms financial outcomes. Because wealth is rarely created by constantly moving capital. Wealth is created by staying invested in the right opportunities, long enough for compounding to work. Michael Rees often highlights that the greatest investment fortunes were built through ownership in enduring businesses, not through short-term trades, not through market timing, but through patience and partnership. And GP stakes investing represents one of the purest forms of ownership in the financial world because it combines recurring income, enterprise growth, strategic partnerships, long-term compounding. Few strategies offer this combination. This is why GP stakes investing continues to attract increasing attention from sophisticated investors. As global wealth grows, more capital flows into alternative investments. And as alternative investments grow, asset managers become more valuable. This trend may continue for decades, which means GP stakes investors may continue benefiting from long-term expansion in the asset management industry. But perhaps the most important lesson from GP stakes investing is this. The biggest opportunities are often invisible to most people. While average investors compete in crowded markets, elite investors search for overlooked strategies. Now let's talk about why the biggest players in the world dominate GP stakes, and why this strategy quietly attracts billionaires, sovereign wealth funds, and elite institutions. Because here's the truth. When you reach a certain level of wealth, the ultra-wealthy don't ask, how do I double my money quickly? Institutional investors love GP stakes for one simple reason: control over economics without operational interference. They gain exposure to the entire investment machine: management fees, carried interest, brand equity, distribution power, without having to manage individual deals.